with the ES. We don't want to lose the ES. Make sure that's pinned. Okay. So, question came in about trading options. And what I wanted to show you is what you have to learn and understand about options are what's called the Greeks. Everybody hates that, but you got to learn it. If you don't understand the Greeks, you're going to be in trouble. It's the bottom line. So, when it comes to trading options, okay, you need to think about options like you think about an insurance policy. And I think my phone is finally letting me type a message here. Okay. So, in other words, with a stock, you want to buy or sell a stock. You want to buy it to be long in the position. You want to short it. You sell it instead in order to be short in the position. So you have two directions for the stock. So, for example, here with Tesla, you can either buy it at 69.34 or sell it at 69.22. Although you'd probably try to sell it at 69.34 if you could. Anyway, so those are your directions with a stock. When it comes to options, you're buying an insurance policy or selling it if you're writing the option policy. But I don't want to get into selling an option right now. That's a later thing you can understand once you wrap your hand around buying it. So think, for example, your house. You own a house, you own some property, and the mortgage company has you buy an insurance policy. Or maybe you bought the house cash, the property cash, but you still want to insure the property. All right. So let's say you go out and you have an acre of land, and you have a small house on the property, and you go buy an insurance policy, and it's going to cost you $2,000 for that policy. All right. So anywhere during that year, it's a 12-month policy. So anywhere in that year, that policy is worth replacing your home, let's say. Let's say it's for purposes of argument that the house is worth $300,000. You have a $2,000 policy, and forget deductibles. Just you spent $2,000 for the policy. You buy the policy, and the next day there's a fire. You go to the insurance company, and they are supposed to be giving you a check for $300,000 to replace the house. You spent $2,000. Now, if the 12 months go by, and you never have a problem with that house, you never initiate anything for the policy, at the end of the 12 months, the policy expires, and the $2,000 that you spent to buy the policy is gone. That's what insurance is, right? You keep spending money on the policy, but you don't get anything out of it until you actually exercise the policy. In this case, have a fire, have a theft, have a flooding, a hurricane, something that's in the policy that would allow you to exercise the policy and convert the $2,000 into the value of the policy, which may be $300,000 or somewhere between. Somewhere underneath $300,000. But my point is, you spend the $2,000, it has a 12-month expiration. Now, options on stocks come in different increments. You don't have to buy a 12-month option. If you look here in the option chain on this program, this is Thinkorswim, you'll see that there are several categories that you can buy the option for, and in parentheses they have how many days to expiration. So there is what would be considered a yearly policy per se. Here's one that expires January 2014. Here's one that expires January 2015. So you can actually buy a policy going out that far if you wanted to. But there are ones that are closer to today's date. So you have weekly options. These are a little more these behave a little bit more erratically if you're new to trading. You might not want to pick up a weekly until you get more familiar with the trading. And there's one expires tomorrow, so it has 1 day to expiration. Here's May 2013, 8 days to expiration. So this expires next week, and it would be considered the monthly option. There's a June monthly option, then there's a September monthly option, and a December monthly option. So these are the policies that the market makers for this company, Tesla Motors, have created policies for those increments. Does that mean there will never be a July option? No, but it's too early for them to write that policy. So they've written quarterly policies, September, December, and then they've written yearly policies, January, and we're just in the middle of those periods now. Okay. Now let's say you're learning about options. So one lesson would be, don't buy options with less than 30 days to expiration. Okay, it'll give you fewer things to affect the price. So let's look at September's. It'll give you a nice cushion on the policy. Now, here is the list of the option chain for September, and what policies can you buy? Well, I'm going to turn on the all and show you that there are option policies for Tesla in September for every single strike price. See the column that says strike. So all of these strike prices are individual policies you can buy. You can get the September 8, you can get the 18 strike, the 19 strike, the 20 strike, etc., etc. And if I scroll down, it goes all the way up to 90. And considering that Tesla's currently trading at 69 and change, and there's a potential for this to go to 100, you might see in the near future they'll write some policies for 95 and 100, but right now it caps out at 90. Okay? All these different choices. I'm going to narrow the choices down and give us just 8 to look at. Now the other thing about options is you have on the left side calls. You see the heading here, it says calls on the left. On the right you have puts. See the heading for puts. So at the strike price of $65, for example, there is a contract for a call, and then there's a separate contract for a put. 2 different contracts that you can buy. 2 different options that you can buy. And as we are just checking in with a user who asked, or a member who asked me about this. So if you're going to, I'll tell you what we're going to do. Let's get out of Tesla and look at let's look at the Spider Index, SPY, because I'm specifically looking at the possibility of the sell in May, for example. And let's say you want to buy yourself some insurance of this going down further. Okay. Now you'll notice right away that SPY has way more choices than Tesla did. Not only do you have the May 1, the one that expires tomorrow, weekly, but then you have a mini as well, and then here's the one for next week, and then there's a mini in there for as well. And if you give me a second, Thinkorswim changed their system once they came out with the minis, and they let you turn off the minis. So let me get rid of them. Okay, so that'll keep it a little easier for us to follow. So some options actually have not only the weeklies, but they even have quarterlies, as you see here. All right, but let's not focus on that. In fact, so that we don't confuse anybody, I'm just going to temporarily turn off my weeklies and quarterlies. So let's just focus on the monthlies for SPY right now. Okay, so we've got May, June, July, August, September. Now in this case they've written them for all the different months. So let's look at August. Okay, and we've got the Greek headings, and let's say you think that this SPY is going to go down It's currently 162.88. It's actually trading up to 163 here after hours, but you still feel that it's going to go down. So then you want to focus on getting a put or purchasing a put. Now, which strike do you pick? Let's say you think it's going to $160 by the end of August. Okay? And let me just say here that options expire the third Friday of every month. Except for weeklies and quarterlies, they have different periods, but for monthlies, it's technically the third Saturday of every month. But of course you don't trade on Saturday, so we always focus on the Friday, every third Friday of every month. So this August option is going to expire in 99 days from today. Now, which strike would you pick? You think it's going to 160. Should you buy the 160? Not necessarily. And that is because you're paying money. Here's a bid and ask, just like you had for the stock, a bid and ask that you're going to spend money to buy the option. This is your insurance policy. Remember the $2,000 that we paid for house insurance? Well, this is the $4.79 that you have to pay on your options insurance, or for an options contract, which is insurance on the stock. Okay? So, some rules of thumb to purchase this. The price here, this $4.79 price, is partly based on the value of the underlying, in this case 162.88, and SPY happens to be one of the few stocks or few options that trade after hours, so these values might have even been adjusted based on the after hours trading going on now. Secondly, it has to do with time. So part of this value of this option is the 99 days that are left. Okay? A third part of the price is the volatility. That's listed over here in the brown numbers. 15% volatility. So, relatively speaking, stocks that have earnings coming out, let's say, their volatility will be much higher. It might be 80, 90, or even more. So 15, relatively speaking, is a low volatility. In this program, you can actually scroll down to, and actually I say that, but I think I'm covering it up. That's why I can't see. Okay. Product depth. No. Options, time, and sales. I got to move the ES out of the way here. Today's option statistics. Here we go. So this data is going to fill in just a second. I'll give my platform a moment to catch up. I just clicked on too many things at once. Alright. Pulling in all that data. So over here on the left you can look at the 52-week volatility. And here you have historical historical volatility is 20%, and the 52-week low here 11, high 25. So the fact that we're sitting for that, what were we looking at? The August. We're sitting at 15%. You can see how that falls within the range. Maybe you'd say that's from the mid to the low end of the volatility range. So not as much of the value is coming from volatility. Okay? So another thing in understanding the Greeks are these numbers here, delta. Okay? I'm just going to teach you two of these Greeks. So the delta represents, think about D for dollar. So this number is related to the dollar of the option, of the underlying rather. So in other words, let's take the $63 put. The $63 put, $163 put, is a 51 delta. It's 0.51. And what that means is for every dollar that the SPY moves, the option will go up by 51 cents. Okay? So, in other words, this is the put side. So, in other words, if if the SPY goes from 162.88 to 161.88, then the value of this option will go from $4.79 to $5.29, or $5.30 really, with the 51 cents. Okay? That's all things being equal. Remember, time is also a factor, volatility is also a factor, but if we're simply looking at the price of the stock moving, in this case the ETF moving, then the price of that option will also move by that amount. So that means if you wanted to, you could spend more money and get a higher strike price, so $167, and this one will move 66 cents for every dollar that the underlying moves. Okay? So that's part of the strategy that comes into buying options, is to understand the differences between whether I should buy the 163 or I should buy the 167. And you're going to have to look at your charts. You're going to have to understand how quickly the stock is going to move to those prices and whether this is a better value than this. Okay? In starting out, I would recommend, and I've changed my stance on this, I would recommend getting something in the neighborhood of a 70 delta. So here in this case, for SPY, you get yourself a 168 delta. Okay? So for every dollar the SPY moves down, you'll pick up 70 cents on this option. And as you get more advanced at this, when this delta starts to move up higher, I'm going to expand this so you can see more strikes. I don't want to give you all of them because it'll be way too many. But if I go to 30, and you see how the delta changes here as we go to each strike, it's about 3 or 4 0.03 or 4 deltas, 77, 80, 83, and you get all the way up here to 93. So if you're buying the 70s and then SPY drops down, let's say 5 or 6 points, and your delta now becomes like 89, like it is over here, then to get more bang out of your buck, you could sell them, and then at that time buy whatever the 70 deltas are at that point. It might be the 163s at that point, or 70 deltas. And that's how you can accelerate your gains with these options. Because once you get out here to 89, 90, etc., you might as well buy the stock. Because for every dollar you're buying, for every dollar the stock moves, your option is moving 90 something cents. You're not really benefiting from the leverage of owning the options. Okay, and you got all the loveliness of the risk with buying the options. So that's why you roll out what your position is when the deltas start to increase. Okay. The other factor to consider is the theta. So over here is the column for theta, and it shows it as a negative 0.02. Okay, so that's 2 cents. So what that means is every day that goes by, this option will lose 2 cents. Again, all things being equal, the volatility is staying the same, and the price of the underlying staying the same, which would be kind of hard to do for the SPY, but let's say it stayed the same for 99 days. For 99 days, you're going to lose 2 cents a day. Now that's important to know if you're deciding to buy an option over a holiday weekend, let's say, because you want to understand that you're automatically going to lose 3 days worth of theta. This is how we call this. So theta begins with a T. Think time. T for time, T for theta. So make sure that when you're buying an option, 2-day weekend, automatically you're going to lose some money on the option. But of course, that's built into the price. It's already part of, as the factors built into the price. So consider that when you decide to buy the option. Now I'm trying to read your questions while I'm talking. Not easy to do. And I see J-Dub giving me some compliments on my explanation, and I hope I'm picking the right things. And I see StockSage mentioning about bouncing between charts. And I've heard of Thinkorswim's charting is good, but not Ameritrade's. I thought Ameritrade took over Thinkorswim, so why do they have different charting and charts? Well, yeah, Thinkorswim was a separate company, and they also had their own broker arrangement at Thinkorswim. But yeah, TD Ameritrade bought them, just like actually TD used to be what, TD Price Waterhouse or something, and I can't even think of what TD stands for, but they bought Ameritrade. It used to be just Ameritrade, and now it's TD Ameritrade. And yeah, they bought Thinkorswim. So when you open an account with TD Ameritrade, you will get access to the Thinkorswim software. And that is a separate program that will get installed on your computer. They also have mobile apps that you can use as well. Separately, if you want to do a web-based trading, then they've got something called Trade Architect that they've been pushing, and that's strictly browser-based trading. You log into their website, and boom, you get into the Trade Architect. So, different programs. It's not Thinkorswim for a browser. It's a different program altogether. Let's see. Reading some more of this stuff here. I really do like TOS. You do have to work on the commissions. I have to say the customer service pretty well, especially on the futures side. That's Pop29's made those comments and said he's even gotten a hold of some of the original TD Ameritrade, or not TD Ameritrade, the original Thinkorswim people in the futures side of things. So that's really helpful. And actually, I had dinner with an old friend of mine and talked to him about commissions. And first thing I find out is he's still paying per ticket prices on his options trading, and he's a heavy options trader compared to me. So I knew right away that if they're giving me, if they waive the per ticket fee for little old me, then they know they're going to do it for him. So I already saved him a bunch of money going forward on his trading. We'll see if he picks up the tab on dinner next time. And then J-Dub let me know that TD is Toronto Dominion Bank, biggest bank in Canada. So, yep, that sounds about right. Okay, so getting back to the puts. All right, so you understand you want to look at time. If you're new to options, I'm going to suggest you get options that are more than 90 days old, and you get and you sell these options before 30 days to expiration. Okay, so if you're at 31 days to expiration, it's time to close out your position. Now that doesn't mean you need to wait all the way to 30 days. You can make money on options the next day. You could have bought this today for $7.56. Tomorrow, SPY might, if the SPX index drops 20 points and these SPYs drop $2 and these options go up to $9, there's nothing saying you've got to hold on to those options until 30 days to expiration. Okay? That's why the value of the option would have increased. Because of why? Because of volatility. Because volatility increased, being that the SPX would be dropping 20 points in a day. That's a major move for SPX to do, and so volatility would pick up, and so the value of the options would also pick up, and therefore you can make your money tomorrow. Sell it, wait till volatility calms down, and then go shopping for another option. You could do that over and over and over again. Now, I'll give you a little example so you understand how this works. And this is something you could do on pen and paper by going back through old charts, or you can take a look at in a platform like Thinkorswim here, and you can do that here. There's a section here called Layout, and I'm looking at the Greek layout, Delta, Gamma, Theta, Vega. So I'm going to click that heading, and I'm going to pick the one that says Theo price and mark. Okay? Theo price means theoretical price, and mark is the actual midway point between the two, the bid and the ask. Okay? That's what the mark is. So theoretical price and the mark price right now are the same price. Okay, so you got the bid and the ask of 751 by 756. The theoretical price is the midpoint, 753. So in other words, as you probably know when you're buying stock, you don't necessarily have to pay the ask price, and you don't need to put your offer at the bid price. You could pick a number in between and hope that somebody on the ask side will actually come down and meet your price. It's an auction. That's how it works, and it's no different with options. Now, because we have the heading of Theo price in here, Thinkorswim throws in some other sections in here, other fields that we can play with. Now, let me change my strikes. I want to go to, let's go to 14, and that will kind of shorten up our list here a little bit. And let's take a look and give that scenario that I mentioned. Let's say that SPX moves down 20 points tomorrow morning and the SPY has gone down $2, and you want to know how much is this going to be worth tomorrow morning. Alright, so you paid, let's say you paid $7.53 here at the end of the day for this option, and we're going to adjust it. So how do we do that? Well, first thing we need to do is change the date. So it currently says May 9th. We're going to change that to May 10th. And already you're going to see that the price went down 2 cents. Okay? Just now, what was 2 cents? Does anybody remember what happened to be 2 cents? And I see you guys having another conversation in the room, so don't mind me. But for those that are following along, the theta was 2 cents. Thank you, Jada. So that's why we just changed the date. We didn't change anything else. We just changed the date, and the price of the option went down 2 cents. Okay. Now, let's adjust the price of the stock. And we're going to say plus $2. I'm going to hit enter. And notice the value of the option. It went down in value. And I'm trying to demonstrate put, so I'm sorry. I want to change this to minus $2. Okay. So minus $2 changed it to $8.97. Okay? So $8.97, $7.53, that's $1.44 difference. And now let's say because of volatility, instead of being 15, and we saw earlier the 52-week high was somewhere like 22 or something, so let's bring it up maybe 3 percentage points on the volatility. Okay. Now we're at 978. Okay? Now again, this is, I'm just playing with the scenario. But here's an example of buying an option and it went up from the 753 to 978 by adjusting these couple of factors. Tomorrow's date change, the price of the SPY going down $2, and the volatility increasing slightly by 3%. Okay? Now, just for comparison's sake, that's $2.35. Let's go down the list here and see what the differences are. So we've got 911 minus 689, and I'm going to use my calculator here. 911 minus 689. So that was a $2.22 move. Then we had 849 minus 629 is a $2.20 move. 789 minus 574 or 575, let's pretend, that's a $2.14 move. So I'm just showing you that if you picked these different strikes that had lower deltas, 66, 62, 58, that you end up getting less money for the same move. So here the 168 strike gave you 235, but the other strikes went to 222, 220, and then 214. So you can see the value in getting a higher strike price that has a higher delta in this example. Okay? The last thing I'm going to mention to you to understand about options is the price that you're going to pay. So you need to understand you're not paying $7.56 for the option. Okay? It's $7.56 per contract, and then every underlying is different. And how to know what the answer is you got to look over here where the date is. See, it says August 13, 99 days to expiration, and then here is the shares per contract. In this case, 100. So when you buy one options contract, it's covering for 100 shares, so you have to write the policy times 100 shares. So in this case, you would spend, instead of $7.53, you're actually spending $753 for one option contract. Okay? Now, as we just pointed out, if SPY happened to drop the way we mentioned, you're going to be up $2.35 times that by 100. It's $235. So that's not a bad return. $235 out of $753. That's a 31% return in one day. Put that over a year. It's pretty good. But again, now you start to build your strategies. You don't buy one, maybe you buy 10. Tomorrow the price goes up, the price of the put goes up, and you sell half of them. You hold on to the other half until things pick up speed. In some strategies, I've heard you would sell 80% of your position, and the 20% is basically a free trade. And then you might even hold on to it for the full, maybe even beyond the 30 days. If you're really that far ahead of the game, you might even hold it all the way down near expiration. But that's, again, a more advanced strategy, and you want to be careful about that. Just for comparison's sake for the boys and girls in the room, let's take the same scenario and look at the monthlies, which expire next week. And let's take a 70 delta. So in this case, it's the 64 halves that are 70 deltas, $1.93. Let's change our theoretical price here. And based on this same scenario, instead of it going from $7.56 to $9.78, it would go from $1.93 to $3.65. So how much is that? $3.65, $1.93. That's $1.72. So here you can see where the time actually helps you, because with a week to expiration, it only went up $1.72. Whereas in the example for August, 99 days away, and it moving like it does, and the volatility changing like it would, you're going to get a $2.35 move instead. So that's a difference of 63 cents, or $63 in this case, that you're going to benefit from by buying further out, 99 days away. So again, lots of ways to make money with this. This is just the basics for you to understand. And if you want to paper trade it first till you understand it, that's great. If you want to dive right in, you should be able to follow these basic rules that I've outlined for you. Get yourself a 70 or more delta. Get yourself a 90 plus day to expiration option. And of course, this is directional. So this is based on, you think the stock's going down, you'd buy a put. You think it's going up, you buy a call. And don't give up your profits. It starts making money, you don't have to hold on to expiration. Now I'm looking back through the notes, seeing if there's any. I guess there really weren't any questions for me. I guess. I wonder. My laptop keeps disconnecting from the chat room. I have no idea why that happens, but that seems to be what's going on. So I'll tell you what. It's getting a little late for me. I've got to go take care of a couple things. Let me close out the trades here, get the ES chart back on the screen for you, and we'll also put back up the stocks that were having their earnings here at the end of the day. And I hope you're able to benefit somewhat from some of the explanation there for you. Hope you enjoyed that.